Well, good afternoon, investors. Welcome to the July 25th, 2023 edition of Bull Sessions. My name is Mark Robertson. I'm joined here by the investing raconteur to the north, Ken Cavula. Good afternoon, Ken.
Good afternoon, Mark.
And we also have, just in case they chime in with comments, Kevin Galogli's here with us, and so is Matt Spielman, at least for the first half of the meeting. So welcome to all of you. This will be an abbreviated session because we do have a roundtable, our monthly roundtable tonight. If there's a couple new names in the audience, so I'll just remind everybody and introduce them to the fact that that is a monthly program. It's a webcast, 8:30 Eastern Time. Again, once a month, generally on the last Tuesday of the month at 8:30 Eastern Time. And it's simply a format where 4 or 5 of us will share an actionable idea for study and further consideration. We go through the analysis of those opportunities, and we've been doing that since July 2010. The internal rate of return on the tracking portfolio is tracking between 15 and 16% annualized. So it's been a pretty good, well, you'll actually see more about that here in a few minutes, but it's actually been a pretty good demonstration of what some crazy people can do when they lean on each other and share ideas. What are your thoughts, Ken?
I've learned a lot from the roundtable, Mark. I've learned that it's not all bad to have a discipline and to not let yourself get wild and crazy very often. I'm a terrible speculator, I've also learned, so I don't move in that field as often as some of you guys do, but I think I'm much more into picking good, solid, up, straight, and parallel stocks and keeping those in our mind as we create this portfolio here.
Yeah, and to answer the question from the green room, yes, I do still own my shares of Western Alliance that I bought, I don't know, a couple weeks ago or whatever. What I think I will do is figure out when the gain that I have in those equals the gain that I had in about 84 minutes a couple of months ago, and and perhaps consider selling at that point. I don't know. Whatever. All right. So we're going to release the hounds and talk roundtable a little bit here today. Here is your weekly reminder that Portillo's does not sponsor this broadcast, but they should. All right, here's your standard normal disclaimer. Everything that we do here is for education. No investment recommendation whatsoever is intended. Everything that we do here is basically based on the 8 decades of successful investing by the Modern Investment Club movement. The discovery techniques, the analysis methods, the portfolio design and management. That's the type of stuff we get into here, and it has quite a track record over time. Nothing in the world of investing is ever guaranteed, so please don't take it as a guarantee, but we have witnessed and experienced that success in many ways. You know, in the roundtable is a demonstration of that at 16% per year over a 13-year period. But please do your own homework before making any investment decision. If we own something, we'll try to remember to mention that. And again, it's all up to you. If you'd like to be added to a roundtable reminder list, again, that's that monthly webcast. Send an email to ncavula1@comcast.net, and we will not inundate you with email. You'll simply be reminded when that roundtable is coming around again. Any other questions or comments or requests for slides? Our 2 email addresses are at the bottom of the page. Anything else, sir?
No, we're staying right on target here, Mark, so keep it going.
All right. Since we do have that tonight, we will try to keep it to fairly short. Okay. All right. So the stock market actually has gone up in the last week, as shown by that green bar on the right, and that has dropped the value line return forecast slightly. It's actually down at all-time averages at 11.6%. That's the last red dot on the right. So again, the market is represented by the companies in the value line standard edition with the green bars, and you can see they zig and they zag, but they generally do pretty much adhere to that blue line, and that's just simply a mathematical trend line provided by Microsoft and Excel. And we consider it to be a line of reasonable expectations. And Ken, I just couldn't get away from Maria. She had two more quotes after last week. I thought you really would like that last one there.
There's no doubt in my mind that Maria Bartiromo was a smart woman, Mark.
And that she
so,
is.
And if she would stick to investing, I would have a lot more respect for her, I think.
All right, enough said. All right. So next, let's go ahead and do our groundhog update. I'm just basically going to dedicate the top 10 positions to new sheriff in town mode, because everybody has kind of joined Matt at the top of the list now, and we see some percolating and bubbling. And the new leader is this Fave 5. It's the launchpad screening technique that we talk about from time to time. Again, inspired by the Broad Assets Investment Club of St. Louis. And then there are a number of names that have been up near the top, and they are, as I said, percolating. The Lone Star of Texas, that's a Dallas investment club, been hanging out near the top of the board for a long time, but they are joined by an increasing number of clubs or investment groups that are shown in the bolded type, including our two-time defending champions down there at number 30. They generally wait until the last day to take over first place.
They're going to have their work cut out for them, Mark. Upstart, which is one of the Fave 5, is up 20% today.
Ooh, nice. Yeah, every once in a while those launchpad stocks work out pretty well. When they don't, it's not pretty. But Ken, you're still on here, right? Where did I?
I'm still hanging on. I'm down to 30, but
Okay.
I'm still hanging in there in the top 40. So we'll see where my portfolio moves. I don't have any banks in this particular portfolio, so that's allowed me to be competitive. That was not by design. It was just by the way the chips fell when I did my choices. But I do notice that Kim is back on the list, and that you've begun to move up the list now, Mark. That's interesting.
Yeah, we're trading blows like Ali and Frazier, and we keep beating on each other, and everybody's going to lap us. So good stuff. Now, Kathy Wood was on the list last week at, I believe, 34th, and she has dropped back down to 55th. The monkey is near last place at 165th. And as we have pointed out for some time, the value line arithmetic average, which is generally one of the top performers over the long term, they are at 98th. And so, again, that's the equally weighted index of the companies that are in the book. And they lagged the Wilshire 5,000 by 40 or 50 places, which it doesn't happen very often that way. So, and the average groundhog checking in at about 2%. All right. Our other regular check-in, and this one's kind of fun this week. We continue to hover close to the Wilshire 5000. That's represented by the VTI Exchange Traded Fund. For the Wilshire 5000, the market, that green bar in the middle, and that's the one we want to beat. And we're pretty close. We're within striking distance. And Ken, I find it a bit fascinating that both of those banks at the bottom will actually be percolating off the bottom.
It's I'm great. I'm finally feeling that we're getting some respect back for these banks that don't seem to have very much wrong with them, other than they're tagged with the name regional bank. So let's see where they can fight to the end of the contest here. This one ends on the 31st of October, so we don't have that long left yet, but we do have a couple months.
Yeah, we could use a good push from Portillo's. A couple of others at the bottom. I'd really like to see Semler Scientific. Semler Scientific has really been a laggard, and we really need to see a little bit more from them. The number that I find kind of fascinating is this one. Again, that is compiled from analyst consensus estimates of what this company could do over the next 52-week period. And they obviously have very high expectations for Semler. That's probably what brought it to our list. You can see the return forecast over here. it's time for it to deliver, and or not. But it is still there. Some of the other ones that are kind of wild, we've talked before. We don't need to belabor it, but we believe that the analysts are wrong about MP Materials and their addition of production capacity. So we'll see how that goes. But in general, not too bad.
I think this is a pretty stark example also, Mark, of the rule of five. We have a couple of stocks that are doing extremely well up near the top there, Technoglass, Monolithic Power, and that's about the 1/5 that does well without us understanding why they're doing so well, and we have a couple that are doing very badly, 3 of them down at the bottom down there. There's your rule of five, folks. I think it can be pointed out in almost any portfolio you put together that you do end up with about a fifth of the stocks outperforming in a really dramatic way, and about a fifth of the stocks underperforming in a very dramatic way. As my beginners classes like to tell me when we talk about the rule of five, it should be easy to avoid that. Just don't buy those stocks at the bottom. But then they stop and listen to what they've said, and everybody has a chuckle. So it happens. It just happens. You need to find a way in a regular portfolio. Probably we would have moved 1 or 2 of these out of the portfolio at a certain time in order to preserve some of the capital that we had invested.
Yeah, in an actively managed portfolio, we may have done that. And
yep.
The one other thing I would point out, we had some fairly positive words to say about Walker and Dunlop, WD down the middle of the graph there. And, they are vested in commercial real estate, and it's probably a pretty good sign that they have been relatively stable considering some of the challenges faced by that particular segment going forward. So we'll continue to hope for the best there. And good stuff. I did replace a couple Yeti coolers this weekend, so I did my part to support Yeti. No, that's all I'm going to say. Family members keep leaving them all over the country, so we're doing their own we're doing marketing for Yeti.
Yeah, Anne is indicating that she bought Service First Bank recently and is doing quite well with the recovery in banks. We've owned in one of my investment clubs, my personal investment club, we've owned Service First right from the plunge all the way until this moment, and we've actually stayed in the green for most of the time we've owned it, but it's been a long-term holding for us. So we had the opportunity to allow it to really move up to a price from a very low base. So we're even at its low point, we were still roughly even with the board on our Service First purchase. So it's a good, solid bank. It deserves your attention, as do a list of probably 15 or 20 of the most conservatively run banks in the country. They don't seem to have that much wrong with them, and the market is beginning to reward those kind of banks on a regional basis now.
Yeah, and in fact, in the case of Service First, we touched on it last week. I do think that the analyst estimates finally caught up, and we saw some of the negative, the pessimism that the bank is kind of working its way through. I think, as a case study, and maybe we'll come back to it in a couple months, I think those numbers are probably now going to start to restore, and so that pessimism was factored in recently, and now perhaps a little bit more optimism is on its way. So time will tell.
Tell you what I've been observing in 2 industries, Mark, in the home builder industry and in the regional bank sub-industry. I observed that 2.5, 3 months ago, the projection graphs for all these banks had the same shape. And that to me said that we had an analyst community that was basically just giving up on the industry and saying they're all going to do the same thing.
Yes.
Uh, I could not believe that the entire group of home builders were all going to have the same issues and going to do the same thing, but they all showed the same projection going forward. The regional banks as well. Now, as the new analyst projections come out to readjust for some of the quarterly things that are happening, you're beginning to see variation in the guesses, in the estimates, in the forecasts for the future growth in sales and earnings for both these industries. And that's the way it should be. These companies are not identical to each other just because they happen to be in the same industry, and they should not have the same forecast growth characteristics one to another. You shouldn't be able to take 15 home builders and look at the graphs and not be able to differentiate between any of them as far as the future is concerned.
Yeah, and one last point, I think Matt has made this quite well with Green Brick Partners out of Texas, and the fact is, real estate's local, and when it comes to the home builders, that has to be factored in also. The economies are not identical across the geographic map of the United States. They do have variations in them. That means it's basically impossible for what Ken just described to be right. They can't all look the same. So it's something to be aware of and look for opportunity. In the case of Service First and Truist, you'll probably hear about that tonight from Cy. Some of these banks are pretty well managed, and probably have the best chance of any to come out well in the long run.
I just think that listening to what Nicholson said about buying stocks in a down market, not even necessarily a bear market, but buying stocks in a stock pickers market, in a challenging market. And his suggestion, his mantra was always buy the best, buy the highest quality you can find. And have good reasons why you're buying that stock. Don't necessarily depend on the fact that some broker indicated buy, sell, hold. We get confused a lot of times that we think that better investing and our whole method depends on the brokers telling us when to buy, sell, and hold, and that's not true. It's our own analysis that tells us whether to buy, sell, hold. And in fact, those recommendations coming out of the brokerage houses are probably the least reliable information that they give to prospective owners of different stocks.
I'll just say amen. Like we could do an extensively long show sharing evidence to support what Ken just said. So, all right, here's again one of our favorite charts that we like to look at from time to time. Probably won't share quite as frequently as we have lately, but this is just a chart of some individual stocks and collections of stocks and how they have done over the long term. Those 6 indices at the bottom go all the way back to 1994. And you can see from top to bottom, they're all spread out from 9 to 11%. The interesting thing, backing up what Ken just had to say, the mid cap and small cap are generally at the top of this list of 6. And they're down here now. So again, we really do believe that there has to be nested opportunity in the small and medium-sized companies right now. The rest of the companies, again, the centerpiece here is this manifest investing, 40 most widely followed companies, basically right down here with many of these index investments. But among those 40 companies are all of these. These are all of our community favorites. These are all held among the most widely followed. And Google is in that list also, along with Fastenal. And the dates that are shown on there are when they were actually added to that 40 most widely followed list. So, for example, Ken was talking about companies like Amazon or Apple, or in this case, Visa. That's a great example. I believe you're bringing that one tonight, Ken, right?
Yes, I am.
So the list was started back in 2005. Visa was not on that original list. It was actually added a few years later, and it has climbed up to the top of the list. So that is the case with many of those. You can see that the tin cup demonstration that we do at Manifest is chugging along pretty well. There's our 8-year track record for the best small companies. And then tonight's investing roundtable, again, checking in at approximately 4 to 5% better than the market. Here is that 15 to 16% return. And that's probably good motivation to see what's on the minds of people like Cy and Kim and Hugh and Ken and Mark and a variety of other damsels and knights that have been presenters over the years. So there you have it. Anything jump off the page, Ken, for
Well,
you?
it doesn't jump off the page, Mark, but it's a confusion of vocabulary. I've been noticing in the last 6 months that more and more as I read about stocks in different phases, different places, whether I read it in print or read it online or wherever I'm reading about it, I'm noticing the tendency to a lot of the newer journalists, the newer writers, to refer to stocks that have consistent growth in sales as growth companies. And they're doing articles about the 10 best growth companies at this point in the market, and you scroll down and you find the list and you take a look at it, and 9 of them have no earnings. And I don't like this creep of definition from what a true growth company has to be, at least in my opinion. A true growth company has to have growth in sales, and it has to have matching growth in earnings in order to be considered a growth company. I just don't think you can go out there, raise a handful of money or a huge handful of money, and then sell something for 5 or 6 years without making a penny and call yourself a growth company. I think we're doing a disservice to the investing public when we do that.
Well, again, I'm going to say amen, amen. I mean, that's a challenge that has faced the industry, that has faced the media coverage of the industry, and even some of the academic coverage of investing. The differentiation between an early stage company, the Amazon of 10 years ago versus what it is today. I think they have earnings now. So they
I think so, yeah.
probably now qualify, but again, early stage is different. It's not core investing. Every time I bring one of those companies, the hairs on Ken's neck stand up, and it's different. Doesn't mean it's wrong, but as Ken said, it's not a pure growth situation, and our community tends to do pretty well with those companies. Again, we were just talking about that Launchpad Invest, the leaders of the pack right now. They watch for that point where earnings go positive and hopefully stay positive, and that's what you want to get a hold of every once in a while.
It's tricky and it can be very rewarding, but it's certainly not classic investing in growth. The way that we talk about it on a regular basis, growth can be kind of dull a lot of times. I mean, Procter and Gamble's a growth company, not a real heavy duty grower, but it's a growth company, and there are a lot of good solid growth companies that have this characteristic of consistent earnings and consistent sales both. In my mind, though, to be growth, you have to earn something. You can't just throw up sales for 4 or 5 years and claim that you got something that's going to beat sliced bread. You can't make that work.
Well, as Matt Spielman and Tom O'Hara have pointed out in the past, just slapping the labels is dangerous all by itself.
Yep.
You ask somebody, are you a growth or a value investor? Most of the people around here are going to say yes. We basically are both. We want great companies at great prices. So it's those labels can be dangerous.
Absolutely.
All right, let's spend just a moment on this one, just a refresher. One of the things that we have followed, again, using the theory that these down here at the bottom probably represent some opportunity. This is actually a look at one of the derivative exchange traded funds based on the Russell 2000. You can see the definition down there at the bottom, and we are interested because we basically think that this long-term trend is probably still intact. It could actually get very interesting if the recession that we've been talking about for the last umpteen years actually ends and or doesn't ever happen. The small and medium-sized companies do pretty well coming out of those. You can see how well these companies did coming out of COVID. You could draw this. You could find the same chart from 2008, 2009, and there is a potential for at least a flavor of that type of recovery in the current situation. So we are kind of placing some bets and monitoring this one carefully. And one of the ways we were demonstrating that is with this notion of a long-term option. And I just wanted to give a quick update. And I also wanted to answer a question that Ken asked me that I couldn't answer last week. Fair enough, Ken?
Fair enough.
Okay. So we are looking at this type of an option. This is a leap, which means that it's a long time out in the future. The reason we do that is we take the time decay out of the option, and we're basically looking at a situation where the underlying security, in this case the Russell 2000, is going to dictate the shape of this curve. Now, the number that Ken had asked about is what is this? And it actually is, if you put the crosshairs anywhere on this page, you will get a number. Well, we actually use this as a case study with the price right there. So with the crosshairs there, you're talking about a price on July 12th. We actually were looking at it when it was a little bit below that, $6. So the price of the option was $6 on that particular day. So you can actually move those crosshairs and see the price at any point in time. Since then, you can see that it's gone from $6 to $7.16. So we've already gained about 17% in a few weeks. And that's basically how you read this chart. So again, you can buy and sell these at any time. So we could literally walk away with a gain of $1.16 for each contract right now. So far so good. And again, it all depends on this preceding graph doing something and approaching that.
Mark, I'm going to question the vocabulary again now. Would that be $1.16 on each contract or on each share within the contract?
It's actually within each share. So it would actually end up being, well, if we sold it now, it'd be $716. We paid $600, so we'd have a gain of $116 on $600.
Okay, so we should stress to the people that you can't buy a single option on a single share. You have to buy an option on a contract, and that's 100 shares. Yep. Uh-huh.
And that's just it's kind of like pickleball scoring. Anybody who's played pickleball, they couldn't make it like ping pong. They couldn't make it like tennis. Options are the same way. They just make it confusing. The basic thing is investing $600, returning $716 at this point. Okay, so that's one of them we wanted to demonstrate. The other one that I wanted to just reinforce is this notion. We took a look at Tin Cup, found something that might be a little bit overvalued or perhaps stagnant. That was Regeneron. Here we're trying to do just the opposite. We want this option because we sold the call, we hold the call, or we hold the money from selling the call, and we would like for that to go to zero. And we would like to see this over time actually do the decay down to zero. And we're actually doing pretty good so far. This was actually down quite a little bit lower than that, down around 22. So the $2,590 that we received to initiate this option, we could have sold it just a couple of days ago for $2,200. So we would have had a gain of $390, literally in just a few days. So again, this is illustrating that JEPI style enhancement of yield. Again, Tin Cup would basically receive this artificial dividend on a transaction like this. So we'll keep an eye on this one. We're not going to fuss over it too much. Again, here's that nomenclature of the price at $25.90 back on this particular day. So you can use this type of chart to establish that.
Mark, is it fair to say that with a leap, We are actually looking to sell at an opportune time, and with this type of option that we're looking at right here, I guess this is a covered call, right?
Yes, covered call.
And with a covered call, we would ideally like to hold it until the call expired beneath where the price is.
Right. So if Regeneron stays around 735, let's say, and doesn't ever reach 740, we simply keep the 2590. The
Right.
call itself expires worthless. We pocket, let's call it $2,600. So that's what we're actually doing. We're within 60 to 90 days of the date. That's what you see up here. So we're buying an option that literally runs out of time just a couple of months from now. So we'll see if it happens.
Now, I don't see an actual date on that September right there. Is there a certain time during the month when they all expire?
Yeah, you can actually find it in the call symbol. You can see this 915. The actual date would be September 15th.
Okay.
Okay. And we just had expiration of July options on Friday, the preceding Friday. Okay. So we'll just keep an eye on this, see how it works out, and report back to the group. And again, it's illustrating this is what those guys are doing at JP Morgan Chase when they're doing the JEPI thing for the utility auto pay portfolio that we do.
Mark, do you remember what the acronym LEAP stands for?
Long-term equity appreciation, something.
Okay.
Look it up. Just look up LEAPS on Investopedia, and they'll take you through a short course.
And this one, folks, is called a covered call. Two of the more conservative types of options you can buy, and two of the ones that are, if you think these are hard to understand, then you don't want to go any further into options.
I'm with you there. I understand that they could be rewarding, but I just get too much of a headache. This one is fairly easy to understand. If you work through a couple examples, that's one of the other things we didn't mention last week. At many of the brokerage firms, you can actually do a what if scenario, with a play portfolio and see how these options behave over time, learn the nomenclature, learn how to use them. I will tell you that even in our family IRAs, I have done several covered calls in much the same way. And it's not regarded as something frisky or dangerous, because you are basically writing this investment. You could call it speculation if you want, whatever. This contract versus something that you already own. That's what the covered means. So it's not seen. It's many people have used covered calls in their retirement portfolios. That wouldn't be allowed if the regulators thought it was something inherently dangerous to investors. Okay.
I'm getting a few of you wanting to know the tax implications, and I just don't think we want to go there right now. I would ask you that if you're interested in doing this, that you talk to your own tax professional about how they're taxed, when they're taxed, and everything else, and what kind of records you have to access. Your broker is going to keep most of the records for you, but you're still going to want to know the results of all these things, because that it is income and it will be reflected on your taxes at the end of the year.
Yeah, and one last plug: if you are an individual investor and find it to be something that you want to pursue, Matt Wilm's investment record keeping software is simply outstanding for this type of stuff, including all of the options things. So I'm not sure I know too many investment clubs that do this type of stuff. I do know some that do it exclusively, but most clubs would probably find it to be a little bit heavy for their month-to-month operations. I don't know. Be interesting to hear from the masses.
It's interesting, Mark, that I know a club in Washington State that does this on a regular basis, and I know that they don't leave it to the once-a-month meeting to handle all the detail. They do have a smaller group within the club that meets on a more regular basis to handle their calls that are happening. So it does take a fair amount of time, but the rewards can push your portfolio up an extra, 1, 2, 3% if you're doing this on a regular basis in a conservative, successful way.
Yeah, and we won't cover it today, but again, that utility auto pay portfolio that we are using, the ticker symbol is JEPI. They're basically using covered calls, and you can see that they take a basket of solid blue chip stocks with a 2 or 3% yield, and they turn it into about a 10% yield. And this is how they're doing it. So if you want to hire somebody to do it for you, that's actually my approach. We own shares of JEPI in our family stuff. So that's something that we do. All right, so I thought it's time to release the hounds for tonight, Ken. And you give some people some homework between now and 8:30 perhaps. So we'll release the hounds. I just love those corgis on the upper right. I believe those were the Queen's favorite. Is that correct?
I think so, yes.
And speaking of favorite,
they were doled out very lovingly to a lot of the grandchildren when she passed away, so that they're being well taken care of without a doubt.
Yeah, we ran into a whole herd of those in at a Michigan city a little while back, Saugatuck. Pretty cool seeing all those corgis. I may have mentioned that here before. And of course, the dog on the lower right is what was our former family pet. He passed away a few months ago, but that was his favorite form of hunting. All right, so here, preparing for tonight, I always like to run this screen referred to as the Ivory Soap screen at Manifest Investing. Many of you are subscribers, so you already know all about this. I just want to reinforce, anytime I'm thinking about roundtable or investing real money, I will very often come in, I make one entry, the Manifest rank, 99.44 in honor of Ivory Soap. And what we're basically looking at here is the combination of quality and the return forecast, projected annual return, known as PAR. And all of the Manifest rank is a combination of those two things. And we're basically asking our database to say, well, what's the top 1/2 of 1% all the companies that we track? So they all should have excellent quality, and they should all have return forecasts which are potentially in a buy zone. So it generates a pretty interesting list of companies. Some personal favorites on there. We've talked about Taiwan Semi. That's been presented a few times at the round table. British American Tobaccos in the tin cup portfolio. I'd like to see that one take off a bit. Malibu Boats, recent selection by a number of clubs. Cy will probably bring Truist tonight to the round table. What are your favorites on here, Ken?
I owned 2 of these on the list, so they're obviously my favorites. I have shares of MP Materials, very small number of shares, and I put some money into that after we put our best small companies list together. It's not doing very well right now, but I like the concept of what was happening there. They mine rare earths, and they're one of the few places outside of China that actually does that. I also have some money in Malibu Boats.
And that's also a best small company.
Yes, and I like that one a lot.
And so
I've owned Malibu Boats for quite a while, much longer than our list has been out. So,
and I think I brought Taiwan Semi. I think others have done that. Ingevity as kind of a play on the electric grid thing a little while back. Just some interesting companies on here. The company that I am going to focus on a little bit here, though, is Albemarle. They're predominantly a lithium company. You see some really decent numbers here, nice growth rates. Well, that will drop down on this month's update just a tiny bit. And really decent numbers here. So here's a look at the company. If you're not familiar, they are a chemical company, but they do specialize in lithium. And of course, that links directly to batteries, electric vehicles, and just general batteries. Does account for about half of their business. Actually, almost 3/4 of their business if you throw the bromine in there. But they make specialty chemicals for a number of processes and products. And so you're looking at a company which has had kind of an interesting run. When the stock price took off and did this that you see here, that increase there actually drove down the return forecast to low single digits, if not negative. So it was really a launch or a takeoff. You can see that quality's been pretty good here. The split in the sales graph, this is just a graphic of sales along with a trend. This just reflects an acquisition or a change in the structure of the company. So we're just paying a whole lot more attention to the right-hand side of that picture than the left-hand side. That growth rate is approximately 10%. Call it 10%, call it 11%. That's the slope of the red line here. So that's what we kind of look forward to going into the future. So you're looking at a company which has a pretty decent situation and very high quality ranking. It's a pretty good balance sheet analysis by anybody. And our two measures of a return forecast,
Excuse me.
the projected annual return, that's based on a growth rate of 10%, a margin of 25%, and a PE ratio of 17 that you see here, approximately 20%. Pretty good looking picture. And then that is also seconded by the projected return on value being in the same neighborhood. So this is a bumpy one. And Ken is going to rain all over my parade here in a second, at least a little bit, maybe a drizzle, but pretty interesting situation. A couple more of the fundamentals. You basically do have a little bit of a transformation here. The question is, does this stay here or does it go back to the previous levels? Do some study, try to figure it out. You can see that the net margins, the earnings are actually elevated. Now, I would call 2022 a bit of a bubble or recovery from COVID, but the analysts basically think that those numbers are going to stay there for a while. Okay, and that the PE is going to be somewhere in that 20 plus or minus range. Kind of the fascinating thing for me is that you have very strong expectations from Morningstar. They consider it to be on sale. So does the wide berth of analysts, known as the analyst consensus. Value Line, however, does not see the same picture. I mean, notice the minus 8.6. I'll just put a big question mark. Either they're right or they're right down here. I'm not sure who's right. Maybe something in between, but that is a big difference. I have chosen to pretty much ignore the Value Line stuff out here because I think Value Line might be being a little bit overly pessimistic. There's no number here. There's nothing here either. All right. And Ken, you were telling me that there may be some impact on this picture. And this go ahead.
Yeah, well, first of all, we should be aware that Albemarle has the potential to have part of its business nationalized. So we should be aware that Chile, where they do a lot of their business, has indicated that it might be at the place in a unspecified amount of time to begin to nationalize some of the resources that Albemarle is mining right now. So we should keep that in the back of our mind. And then lithium's really hot right now because it's one of the components of some of the batteries that are anticipated being used for some of the electronic vehicles that are being manufactured. I've been very interested in alternative sources for batteries, and I've been watching very carefully some of these salt-based batteries. You heard me right, plain old salt. If that particular battery gains some traction and is as good as right now the researchers are claiming, then it's going to change some of the pain that's involved in getting the rare earths, getting lithium out of the ground. It's not an extremely prevalent metal to begin with, and then getting it out of the ground is an extremely dirty process. So if we can move to something that's readily available and more importantly, very cheap, that would be a game changer for the electronic vehicle industry. I've been reading for the last month now, and it came across again yesterday in an article where the University of Maryland is experimenting with a chitin zinc-based battery. Chitin happens to be a natural material that makes up the exoskeleton of a lot of shellfish and a lot of insects. It's what makes them rigid and gives them the shape so they can walk around rather than float around like a jellyfish might. Chitin is also very prevalent, a relatively easy resource. What we should understand is that right now it's discarded. It's a waste product from a lot of different things. You'd think, well, the first place you go is with crab processors and lobster processors and things like that. But actually, you probably do better in learning to farm it from insect populations. Each insect is much smaller, but together you can probably get a heck of a lot more of the item. But it's a combination of chitin with zinc, which is one of the more common metals in the Earth's crust, easier to get at, not as polluting, nearly not as polluting as a lot of the harder to mine metals are to the environment. And you might want to read about these chitin/zinc batteries that their biggest plus right now seems to be the number of times they can stand to be recharged. There's a lot of really good batteries. The limiting factor on some of them, however, is that you can't recharge them the number of times that you would like to be able to recharge a car's battery. So you want a battery that can be recharged literally thousands of times rather than hundreds of times. And this chitin zinc battery, again, a lot of the research coming from the University of Maryland and from some English universities. Nottingham University in England is one of them. And just starting to hit the media, the media that most people are familiar with and read, being transferred from technical papers into popular journalism so that people can understand what it is and begin to think about it. I'm not aware of any way that we can make a play on it right now with stock investing, but it really seems that as we continue the process of moving forward with different types of technology, we're also finding better and cheaper ways to deal with what might be happening. Before we started the session today, Matt Spielberg was talking about an article in the Wall Street Journal today. My Wall Street Journal is sitting unread on the kitchen table right now, so I'll go there after we finish and try to find it and read it. But the article states that our history shows that we're never really going to run out of resources. What we're going to be doing is switching all the time to resources that are available, and we're going to be smart enough to make them work for us in ways that we never anticipated that we just never anticipated. Think about what we do with sand right now. Another name for sand is silicon, and all these chips that we're dealing with right now are just made out of silicon. So that's enough blathering there, but I would just want to bring your attention to this battery that's made of chitin and zinc, and maybe you can find some articles and read them. And if you find an especially good one, don't be afraid to send the link to Mark or myself, and don't be afraid to post it on the Manifest forum if you see it.
Yeah, Matt has posted about some iron battery type work. You know, the question here, as you consider an investment in Albemarle, is this is real. I mean, the power, the battery energy is going to have to come from something. So the growth is there. Many people think that the impact in the whole ecosystem of the batteries is actually underestimated, total system impact. So there's going to be quite a demand. And as Ken has suggested, the innovation unleashed, and it's certainly unpredictable, but it's going to be interesting to see where this stuff goes. But the demand is you can put a lot of stock in the demand, and then the question to be asked: does this get unseated at some point, and to what extent? So, good stuff.
Yeah, I just want to remind people in our audience that about the very first computer you ever bought. I know the average age of our audience, and you know, most of you aren't spring chickens, and that means you bought your first computer 35, 40, 45 years ago. I want you to think in your mind the huge advancement that has been made in computers, and we're walking around today with a tool in our pocket that is hundreds of times more powerful than that first computer that you laid down money for. I will just tell you that the first computer that I actually purchased that I didn't make was a Radio Shack computer that was already all made, and I spent $2,600 for it. Now that's not 2023 dollars. That's 1980 something dollars. And at that particular time, $2,600 was a lot of money. But I had to have a computer. I didn't know what I was going to use it for, but boy, I had to have one. So think about it, folks.
Mm-hmm. Anytime you're dealing with technology and that sort of thing, it is something to consider. Other thing to consider is the past behavior of a company like this. You can see that they have had these periods of consolidation, whatever you want to call it. Is this one of them? I don't know. Time will tell. But it's something to factor into any decision that those have been followed by fairly decent periods shortly thereafter. So if that all falls into place, could be a very good thing. All right, since we have our show tonight, we'll go ahead and begin to shut down here. Keep in mind that we do put all of these sessions on YouTube under Manifest Investing. You can find the bull sessions. You can find the monthly roundtables also, along with, from time to time, we'll have a special educational session. And here's an announcement. That happens to be Burt Lake up in the upper part of the Michigan Peninsula, and we will be heading there this weekend. It is my wife playing the bass line by the lake, and that's my, at the time, 2 or 3 year old grandson waiting his turn to play. And that's my way of saying, I think we're going to take next Tuesday off, Ken.
Sounds good to me, Mark. Sounds good.
Because this is surrounded by a bunch of trees and not a whole lot of waves and towers. So what I'm telling you is the internet connectivity can be a challenge out in the boondocks. So that's
I'll tell you, it works fine for me, Mark. Just you need to relax every now and then, and you do an awful lot for this community. It's nobody's going to begrudge you a missed bull session, I'll tell you.
I still think that Head should have used this as a commercial because I think that's a pretty cool picture, and I may be biased because it's my grandson. I would also point out that Ken has actually sat on the deck of this establishment and watched me dominate on that tennis court.
I'll agree that I sat on the deck and watched. I'm not going to necessarily agree with the rest of it, but I did sit on the deck and watch you play tennis. All right.
All right. So with that, anything left in the hopper, Ken?
I just want to share with everybody that last week Ann Cunia's husband lost a long battle with cancer. If you'd like to drop Ann a note, her email address is annc@betterinvesting.org, and you can find Rod Cuniaz. You can find his obituary online. He's at a funeral home in Birmingham, Michigan, and you can find his obituary there, and you can leave a message online there as well. It was a long battle, and Ann is taking some time off from work right now, and I know that she would appreciate kind thoughts from anybody.
I'll just say amen one more time. Rod's a heck of a guy, and our heart goes out to Ann and their families at this time. All right. Anything else, sir?
No, I'm all ready for tonight, Mark, and we're glad that you had time to come with us this afternoon, folks. And come on back tonight. We'll give you some good stock ideas.
All right. Take care, everybody. Now I got to figure out if I want to stick to Albemarle for tonight.
All right.
Take it easy, everybody.
Bye-bye.